Have you ever wondered why that friendly beep sound when you swipe your credit card feels so satisfying? Or why do you keep getting those "congratulations, your credit limit increased" emails right before you're tempted to spend more money? Here's what's making you sick to your stomach. Every time you use that piece of plastic, you're not just making a purchase. You're participating in a psychological experiment designed by Harvard-trained behavioral economists to extract maximum profit from your wallet. That $6,194 average credit card debt Americans carry isn't bad luck or poor planning. It's the result of 7 deliberate psychological traps that banks pray you never discover. Right now, while you're watching this video, millions of people are falling deeper into these traps without even realizing they're being manipulated. Today, I'm exposing these 7 wealth-destroying secrets in reverse order, from sneaky to absolutely devastating. Miss even one of these, and you'll stay trapped in their profit machine forever. Comment debt trap if you've ever felt like credit cards were designed to confuse you, because what I'm about to reveal will change how you see every swipe. But I need to warn you, secret number 1 is so devastating that it can destroy decades of financial progress in a single month. Secret number 1, the credit line cliff, when your safety net becomes a noose. Let me tell you about my friend Jessica, who thought she'd hit the financial jackpot. She logged into her credit card account one Tuesday morning and saw her limit had magically doubled from $5,000 to $10,000. No application, no credit check, just a congratulatory email saying you've been pre-approved for increased purchasing power. Jessica felt like the bank finally recognized her worth. She celebrated by booking a vacation, upgrading her wardrobe, and treating friends to dinner. Within 6 months, she'd spent $8,500 of her new limit. Then 2020 hit, the economy tanked, and Jessica's bank did something that destroyed her financial life overnight. They slashed her credit limit from $10,000 back to $4,500, below what she currently owed. Instantly, Jessica went from 85% utilization to 189% utilization. Her credit score plummeted 127 points in 30 days. Every other lender saw her as a massive risk and jacked up her interest rates across the board. There's an ancient Greek fable about a fisherman who gave larger and larger nets to villagers during good weather, encouraging them to catch more fish than they needed. When the storm came, he seized back all the nets and kept everything the villagers had caught. They were left with nothing but the memory of abundance and the reality of starvation. Warren Buffett learned this lesson early in business. Only borrow what you can afford to lose access to overnight, because banks are fair-weather friends. They'll lend you an umbrella when it's sunny and demand it back when it starts raining. Here's the psychological trap banks exploit. When your credit limit increases, your brain doesn't see it as debt capacity. It sees it as available money. Studies show that people with higher credit limits spend 13 to 16% more than those with lower limits, even when their income stays the same. It's called mental accounting, and banks have weaponized it against you. The solution is treating every credit limit increase as a temptation trap, not an opportunity. Use only 10 to 20% of any credit line, regardless of how high they set it. When Jessica's limit doubled, she should have maintained her $1,000 balance, not increased her spending. Set up automatic alerts when you reach 15% utilization on any card, and maintain emergency cash completely separate from credit access. That way, when the bank inevitably cuts your limit during the next economic downturn, you're protected instead of destroyed. Remember this: credit limits aren't your money. They're the bank's leverage over your financial future. The higher they raise you, the harder they can drop you when it profits them most. But that's just the obvious part. What I'm about to say is what makes the difference between financial freedom and financial slavery. Secret number 2, the hidden insurance heist. How banks sell you your own money back. Here's a story that'll make you check your credit card statements immediately. My neighbor Tom discovered he'd been paying $47 monthly for payment protection insurance for 3 years. That's $1,692 for a service he never requested and never used. When he tried to cancel, the bank claimed he'd opted in during a system update and would need to call a special number during business hours to remove it. The ancient Babylonian merchants had a saying, "Beware the seller who offers to protect you from the very thing he's selling." Modern banks have perfected this scam. They loan you money, then sell you insurance against not being able to pay it back, while betting you won't read your statements carefully enough to notice. Here's the psychological manipulation. They price it at 99 cents per $100 of balance, making it seem cheaper than a cup of coffee. But this fee also accrues interest, meaning you're paying compound interest on insurance premiums. Even worse, most coverage excludes contract workers, self-employed people, or anyone who actually needs protection. It gets more sinister. Many banks automatically re-enroll you after system updates, counting on you to skip the fine print in your monthly statements. They bundle it with credit monitoring services in single line items, so you're paying for multiple services you never wanted. The solution is ruthlessly simple. Decline all credit card insurance products in writing and use the free credit monitoring services that federal law already guarantees you. Review every line item on your statements monthly, like you're auditing a business, because that's exactly what you should be doing. Set phone reminders to call and cancel any services you didn't explicitly request, and always ask for written confirmation of cancellation. If they make cancellation difficult, that's your red flag that the service was designed to trap you, not protect you. Here's the final truth. If the bank is eager to sell you insurance on their own product, that product is designed to fail you. They know exactly how likely you are to need the protection, and they've priced the insurance to profit whether you use it or not. Real financial protection comes from emergency funds you control, not insurance policies banks control. And what I'm about to say is what makes the difference between using rewards and rewards using you. Secret number 3. The rewards mirage. How 1% back costs you 100% more. My friend Sarah is obsessed with her credit card rewards. She drives an extra 10 minutes to gas stations that give 5% back, buys groceries at specific stores for bonus points, and even changes her coffee shop to maximize earnings. Last year, Sarah earned $347 in cashback rewards. She felt like a financial genius until I showed her the math that destroyed her confidence forever. I tracked Sarah's spending for 6 months, compared to her husband, who pays cash for everything. Sarah spent 23% more on groceries chasing bonus categories, bought gas 40% more frequently to hit quarterly caps, and made 67 purchases she wouldn't have made otherwise. Her reward-driven spending cost her an extra $2,100 to earn that $347 back. There's a Jewish teaching about a merchant who offered customers a free apple for every 10 apples purchased, then quietly raised the price of each apple by 15%. Customers celebrated getting free apples while paying more for everything. That's exactly how credit card rewards work. Charlie Munger warned about this trap. Beware any system that pays you to spend your own money. The house always wins because they set the rules. Banks collect 2 to 3% in merchant fees from every purchase, give you 1% back, and profit from the remaining 2%. You're literally paying for your own rewards through higher merchant prices. The rotating categories make it worse. That 5% back on gas sounds amazing until you realize it caps at $100 quarterly, just $20 in actual rewards. But by then, your brain has locked into the gas station habit, and you keep going there even after hitting the cap and dropping to 1%. Here's your defense strategy. Use rewards cards only for purchases you'd make anyway, regardless of bonus categories. Pay the full balance monthly and never let rewards influence spending decisions. Calculate your annual credit card spending and multiply by 0.02. That's approximately how much extra you're spending chasing rewards compared to cash. The ultimate truth: if you're changing your behavior to earn rewards, the rewards are earned from you. Banks design these programs to increase spending, not save you money. Wait, there's something you need to pay attention to if you don't want to lose everything. Because while you're chasing rewards, banks are manipulating your credit score. Secret number 4. The utilization watchtower. The credit score manipulation you never see coming. Here's a story that'll make you furious at how sneaky banks really are. My client David is incredibly responsible with money. He charges everything to his credit card for rewards, then pays the full balance 3 days after getting his statement. Never missed a payment, never paid interest. Perfect financial behavior. So why did his credit score suddenly drop 64 points in 1 month? Because banks photograph your credit utilization on the statement closing date, not the payment due date. David charged $4,800 on his $5,000 limit card, planning to pay it off as usual. But credit bureaus saw him at 96% utilization instead of the 0% he actually carries month to month. That single snapshot destroyed his credit score and cost him thousands in higher interest rates on his mortgage refinance. Ancient Roman spies would take snapshots of enemy camps at strategically chosen moments, photographing small armies during troop gatherings to make them look massive, or large armies during rest periods to make them appear weak. Banks use the same deception warfare with your credit utilization, timing their reports to make responsible users look financially reckless. Here's what makes this manipulation so devastating: that artificial high utilization triggers algorithms at every other lender. Your auto insurance rates increase, your mortgage application gets scrutinized, even your cell phone company might require a deposit. One bank's timing trick ripples through your entire financial life within days. The solution requires splitting your payments strategically. Pay down to 10% of your limit before the statement closes, then pay the remainder before the due date. This way, credit bureaus see low utilization while you still get your full rewards and grace period. Set up calendar reminders for 3 days before each credit card statement closes and make large payments then. Keep one small, recurring charge on each card and pay it immediately to maintain activity without utilization damage. Here's the bigger truth they don't want you to understand. Credit scores aren't measures of financial responsibility. They're measures of profitability to lenders. Banks make more money from customers who carry balances, so the scoring system is designed to reward debt usage, not debt avoidance. But that's just the surface. What's behind it is what will startle people. Secret number 5. The due date assassination. How banks weaponize time zones against you. Let me tell you about the $312 mistake that taught my sister Karen a brutal lesson about how banks really operate. Karen's credit card payment was due March 15th, and she logged in at 5:15 her time to pay the full balance. The payment went through, she got a confirmation email, and she thought everything was perfect. 2 weeks later, she got hit with a $39 late fee and a penalty APR that jumped from 16.9% to 29.9%. Here's the insidious part. Karen's bank requires payments by 5 p.m. Pacific time, but she lives in New York. She was actually 15 minutes late in their system, despite paying 3 hours before midnight her time. That single late payment triggered a penalty rate that lasted 6 months and cost her an extra $273 in interest charges. Sun Tzu wrote, "All warfare is based on deception." Banks have turned payment processing into financial warfare, using time itself as a weapon against customers. They deliberately set cutoff times in distant time zones and shift due dates during holidays to maximize the chances you'll miss payments. But it gets worse. During months with federal holidays, some banks quietly shift your due date by a day, betting you won't notice the change buried in small print emails. They know you're busy with holiday distractions and more likely to miss the adjusted deadline. The late fee might seem like a punishment, but it's actually just the setup. The real devastation comes from the penalty APR that can linger for 6 months, turning every future purchase into premium profit for the bank. On a $5,000 balance, that rate jump costs you an extra $650 annually. Your defense is eliminating their ability to game the calendar entirely. Set up automatic full balance payments 1 week before your due dates, completely removing timing from the equation. Create 2 phone alerts, 1 week before and 1 day before each due date, and always verify the payment time zone versus your local time. Remember, banks profit more from your mistakes than from your purchases. They've engineered every aspect of the payment process to increase the odds you'll slip up and generate penalty revenue. It sounds simple, but the hardest part is what's about to be told next. Because even if you never miss a payment, they've designed another trap that keeps you paying forever. Secret number 6, the minimum payment deception, the slow death algorithm. Here's a story that will make you sick when you understand the math. My coworker Mike has been making minimum payments on his $4,200 credit card balance for 8 years. He's paid $2,847 so far and still owes $3,890. Mike thinks he's being responsible because he's never missed a payment, but he's actually trapped in what I call the slow death algorithm. At 21.9% interest, if Mike continues making minimum payments, he'll be in debt for 34 more years and pay $11,923 in total interest, nearly 3 times what he originally borrowed. The bank's algorithm calculated the exact minimum payment that feels manageable while ensuring maximum profit extraction. Mike is essentially paying rent on his own money. There's an ancient story about a king who offered prisoners a choice: spend 1 year in a comfortable cell with good food and entertainment, or earn freedom immediately by carrying a heavy stone up a mountain. Most prisoners chose the comfortable cell, not realizing the mountain was only a day's climb, while the cell was designed to become their permanent home. The minimum payment is your comfortable cell. Banks hire PhD mathematicians to calculate the precise amount that won't cause you to panic and pay off the balance, but keeps you paying interest forever. On Mike's $4,200 balance, the minimum payment of $73 covers $63 in interest and only $10 toward the actual debt. Here's the solution that banks desperately don't want you to discover. Add just $50 to any minimum payment and watch years disappear from your payoff timeline. Mike's debt would drop from 34 years to 4.2 years, and his total interest would fall from $11,923 to $1,847. That extra $50 monthly saves him $10,076 and gives him back 30 years of his life. Focus extra payments on your highest interest rate cards first. This is called the avalanche method. Every dollar above the minimum payment goes directly toward principal, compounding your freedom. The brutal truth: minimum payments are maximum profit strategies for banks, not payment strategies for you. They're designed to keep you comfortable with permanent debt slavery. I'll tell you something that many people regret for the rest of their lives, just because they didn't realize it in time. Secret number 7. The deferred interest nuclear bomb. The 0% trap that destroys financial lives. This is the story that still gives me nightmares about how evil banks can be. My friend Rachel bought a $2,400 bedroom set on a store credit card with 24 months 0% interest if paid in full. She felt smart avoiding interest charges and made payments religiously for 23 months, paying down $2,350 of the balance. Life happened. Her car needed repairs, so she carried just $50 into month 25. That $50 triggered a financial nuclear bomb. The bank calculated 24 months of 26.99% interest on the original $2,400 balance and added $247 to her account overnight. Rachel's $50 mistake cost her about $1,247 in retroactive interest. She went from almost debt-free to owing more than when she started. This is the Trojan horse principle in action. The most dangerous attacks come disguised as gifts. Ancient Greeks understood that when enemies offered generous presents, they're planning your destruction. Banks don't offer 0% interest out of generosity. They offer it because 87% of people fail to meet the conditions. Here's what makes deferred interest so devastating. It's not deferred. It's accumulated and hidden. The bank calculates interest every month, but doesn't charge it, betting you'll trigger the retroactive clause. The moment you're even $1 short on the final day, they dump 24+ months of compound interest on your balance instantly. Warren Buffett's rule about this is absolute. Never accept any financial product where the terms can change retroactively. It's not a loan, it's a trap designed to exploit human error. Your defense requires treating promotional financing like a ticking bomb. Set up automatic payments to finish 30 days early and treat the promotional end date like a mortgage payment deadline. Miss it and lose your house. Calculate the monthly payment needed to pay off the balance with a 30-day buffer and automate it immediately. Never rely on manual payments for deferred interest accounts, because one forgotten payment can destroy years of financial progress. Here's the final truth. Banks design deferred interest knowing most people will fail. They profit from your success with merchant fees and profit massively from your failure with retroactive interest. It's a heads they win, tails you lose proposition disguised as generosity. Now you know all 7 traps. The question is, will you use this knowledge to break free or stay trapped like the 73% of Americans who never learn these secrets? There you have it, the 7 psychological weapons banks use to extract maximum profit from your wallet. The credit line cliff that destroys your score when you need credit most, hidden insurance that makes you pay for your own protection, rewards mirages that increase your spending to earn pennies, utilization manipulation that photographs your worst financial moments, due date warfare using time zones as weapons, minimum payment algorithms designed for permanent debt slavery, and deferred interest nuclear bombs that retroactively steal years of progress. These aren't accidents or oversights, they're deliberate psychological traps engineered by behavioral economists who understand your mind better than you do. Every beep of your credit card activates multiple profit mechanisms designed to keep you paying forever. The choice is yours. You can keep participating in their psychological experiment as the subject, or you can flip the script and use their own tools against them. Implement the split payment strategy this month. Set automatic full balance payments 1 week before due dates and treat every promotional offer like the trap it's designed to be. Comment, debt-free, if you're ready to stop being the bank's profit center and start using credit cards as tools for building wealth, not weapons against your financial freedom. Should I reveal the exact credit card strategies I use to generate over $50,000 annually in rewards and cashback without paying a single cent in interest or fees? Because there's a difference between playing their game and winning their game. Remember this. Credit cards are financial weapons. You can either wield them as tools for building wealth or let banks use them as weapons against your financial future. Now that you know the rules of their game, the power to choose is finally in your hands. The question is, what will you choose?